My name is Jake, welcome to the channel. In today's video, we're gonna go over one of my favorite dividend growth ETFs in DGRO. And I'm gonna share in this video exactly why. For a lot of you watching this video, a lot of you are interested in investing into dividends, dividend growth, high dividends, whatever it may be. It really depends on your goal. Whatever your goal is, that's how you should be constructing your portfolio. So what I always like to think about is your portfolio is the vehicle to help you get to the destination that you want to be at. The important thing with investing, in order to pick the right vehicle, you have to know the destination. You have to know when and where you ideally will be when you're looking to live off of your portfolio. Whether you're living off of your portfolio and liquidating the shares and living off of the traditional 4% rule, or if you're living off of the dividend income from your portfolio, it is so important that you understand your goal and then working backwards. In this video, we're going to cover 5 topics. The first, I'm going to go and do a deep dive into DGRO and explain exactly what you're getting when you invest into an ETF like DGRO. Second, we're going to look at the Morningstar US Dividend Growth Index. This is the index that DGRO follows, and so whatever the performance of this index is, essentially that's the performance that you're going to be getting. So it is so important that you understand this index. Third, we're going to compare DGRO with the traditional dividend growth ETF in VIG. This is the Vanguard Dividend Appreciation ETF, and I'm going to share some of the differences of how DGRO compares to VIG. And then fourth, we're going to compare DGRO with the S&P 500. So we're going to benchmark the performance of DGRO with the S&P 500. And last, I'm going to share who should consider investing into an ETF like DGRO. If you look up anything on investing here on YouTube or on the internet, it feels like everyone and their dog is talking about the next hype thing to invest in. In my opinion, there's a lot of good and bad investment ideas out there. DGRO is an all-around responsible investment, one that I could feel comfortable dollar cost averaging into on both green and red days. Regardless of DGRO being a responsible investment, I'm sure some of you in your early 20s watching this video are going to feel a little like this.
Listen, you got at least 3/4 of your life to go. That's 3 more lifetimes to you. So don't blow it. Don't do drugs. If you're doing it, stop it. Get some help. McDonald's wants you to give yourself a chance to find out all the wonderful things you really can be. And so do I.
Oh my gosh, Michael. Okay, all right, so DGRO is from iShares by Blackrock. So what is the fund's goal? The iShare Core Dividend Growth ETF seeks to track the investment results of an index composed of US equities with a history of consistently growing dividends. So this ETF is tracking the Morningstar US Dividend Growth Index. So it's only focused on the United States. And so some highlights or why DGRO, some selling points on what makes DGRO unique is DGRO offers a low cost exposure to US stocks focused on dividend growth. So the cost here is the expense ratio. The expense ratio is actually really low. It's 0.08%. And then second, it accesses companies that have a history of sustained dividend growth and that are broadly diversified across industries. It's just focused on the United States. It's focused on companies that have historically increased their dividend. But the important thing here is it's also focused on tax efficiency. So it's just US companies. So you're not going to get any international tax, assuming that you're here in the United States, as well as it doesn't have any exposure to real estate. And then third thing here is it used at the core of your portfolio to seek income. I think this really has to be taken with a grain of salt because when comparing to other ETFs that I've shared here on the channel, they're very different. So DGRO is more focused on dividend growth, but when you do compare it to, like, for example, the S&P 500, yes, you are getting more income being the dividend. Your top holdings are Microsoft, Apple, Johnson & Johnson. So those top 3, let's look at that for a second. Microsoft and Apple, these are core technology companies. Johnson & Johnson is a core healthcare company. So very, very different. And then even if you consider Verizon, if you were to compare Verizon and Microsoft together, they're very, very different. And then you have in here a Procter & Gamble, a Pfizer, a JP Morgan, Home Depot, Merck, and Cisco. So when you look at this, these are large cap companies. These are best of breed companies from a lot of different industries. So DGRO has actually not been around for very long. It's only been around since 2014. As I mentioned, it has a fairly low expense ratio. It's following the Morningstar US Dividend Growth Index, which we'll talk about in just a second. It has a low starting dividend yield of only 2%, but comparing to the S&P 500, it is higher. The number of holdings this is a very diversified ETF with almost 400 companies in this ETF. And it has just around 19 billion in assets, so assets under management. So this is not a small ETF. When looking at the sector breakdown, we can see that financials is the highest sector, followed by information technology, healthcare, and industrials. And this is really interesting. What you'll notice in the next section when we talk about the Morningstar US Dividend Growth Index, it will make a lot of sense of why this sector allocation is set up the way that it is, because it's focused more on growth sectors that have more potential for growth in the future. When it comes to the dividend growth of this ETF, it's averaged just over a 10% dividend CAGR year over year. So if we were to look at this year over year, in 2015, if you were to purchase one share of DGRO, you would have been paid out just under 65 cents annually. And when looking at 2020, you would have been paid just over $1 for every share that you own. And so this is really the magic of compound interest. Every single year, the dividend is growing. Of the just nearly 400 companies in this ETF, I think a large majority of them you are going to recognize as a consumer. You know, we talked about the first 10, we talked about Microsoft and Apple and JP Morgan. The percentages here may be a little bit different than the website we were just looking at because this is on ETF.com. But if you scroll down here, you can see that PepsiCo is in here. You can see that Morgan Stanley is in here. You can see the McDonald's is in here. You know, MJ knows about McDonald's. You got Bristol Myers, you got 3M, Medtronic, Nexter Energy, Oracle, Caterpillar. A lot of these companies, Kimberly-Clark, Nike, Costco, MJ also knows Nike, Anthem, Emerson Electric. A lot of these companies, your average person is going to recognize. And I think this is so cool when you're investing into an ETF like this, that the majority of the companies in here, you're gonna be like, oh yeah, I know this, or I've heard of this brand. A lot of times when we invest into ETFs, you look at the bottom half of the companies in the ETF and you'll be like, I've never heard of that company. But then you got like, we're halfway through and you got Stanley Black & Decker, you got Western Union, you got Cintas, you got Whirlpool, you got Hasbro, like, a lot of these companies, a lot of you are going to be familiar with. So now let's take a look at what the Morningstar US Dividend Growth Index really is. And so what is the methodology behind this index? So the Morningstar US Dividend Growth Index is designed to provide exposure to US-based securities with a history of uninterrupted dividend growth. The index is a subset of the Morningstar US Market Index, a broad market index representing 97% of US equity market capitalization. So really, really large cap. It is a benchmark consisting of securities that, for example, pay a qualified dividend. So that means no REIT, are screened for a minimum of 5 years of uninterrupted annual dividend growth. And then lastly here, have a significant margin to continue growing their dividends. This is really focused on the payout ratio, and we'll get to that here in just a second. Now, one thing that I would say that is kind of a drawback to this index is this index does not incorporate environmental, social, and governance criteria. So no ESG when it comes to this ETF. However, you will be surprised that there's not a lot of sin stocks in this ETF because I've checked. So the core methodology of this index is it's selecting US stocks only. And then from there, it's focusing on companies that pay a dividend but are not part of the 10% of the highest dividend payout. Also, the dividend must be qualified. This is, what we were talking about earlier with qualified versus non-qualified. There's no REITs in here. So you can hold this in a taxable account and get the best tax treatment treatment. And then here, the 5 years of annual uninterrupted dividend growth. And this is the interesting thing here, a positive consensus earnings forecast and payout ratio of less than 75%. This is really, really important. So if a company is paying out over 75% of their net income, that means they're not going to be able to grow the dividend as quickly. So a lot of the utilities out there, they're not going to be able to be included in this index because they have their payout ratio is too high. However, there are a few, high quality dividend growth utilities in there. For example, NextEra Energy and Duke is part of this index, but Southern Company, for example, is not part of this index. So you really are only getting the best of the best with this index. So how does DGRO compare to VIG? VIG is kind of the poster child of dividend growth ETFs. I think another one out there is maybe Noble, but we're going to just talk about VIG today. So VIG tracks a market cap weighted index of US companies that have increased their annual dividends for 10 years or more. So what this means is companies maybe like Apple are not going to be part of this index. Companies that have only increased their dividend for less than 10 years will not be included. And I think that the drawback with this is there's a lot of great technology companies that are up and coming that are, would maybe be paying a dividend here in the near future. They would be excluded from this index or from this ETF. Let's say, for example, a wild example, let's say Amazon, maybe here in a couple of years, decided to pay a dividend. Amazon would not be included in VIG, for example. So, and also not in DGRO for the first 5 years, but after the 5 years, it would be included. So it's something to kind of consider. It's not a crazy big deal, but it's something to consider. And there are other metrics that VIG follows. It's not just 10 years. For example, it excludes the top 25% of high yielding companies. So, your sin stocks like Altria Group are obviously going to be out of there, and other large high dividend companies as well. A few other things that are really important to understand when we're comparing the two is they have a very similar expense ratio. The assets under management are almost 3 times higher or more than DGRO. So VIG is a really popular ETF. And another thing that's important here is there's just under 250 companies in this ETF. So there's a lot more in DGRO. So those are the main things that you need to understand when you're comparing DGRO with VIG. When looking at the performance of DGRO and VIG since the beginning of 2015, their performance has been very, very similar, like almost to a T. It's just incredible. So if you had one portfolio with only DGRO and another portfolio with just VIG, you would have gotten very, very similar performance, total return, so the dividend plus the capital appreciation in both of them. So it's really interesting to see that they are very, very similar. They track a very similar index. Though they are different, they do have a lot of overlap, which we'll get to here in just a second. If you look at the performance from January 2015, you can see that they've tracked each other pretty much to a T. So they're really, really similar. And if you look at the annual performance, they've also been very, very similar. And when comparing the two since January 2015, you can see that DGRO just slightly outperformed VIG. So what does this mean in practical terms? If you would have invested $10,000 on January 2nd in 2015, if you would have purchased DGRO at $26.51 and VIG at $81.02, you would have had the following shares: 377 shares of DGRO, 123 shares of VIG. And when looking at the current dividend per share today of $1.05 for DGRO and $2.55 for VIG, you can see that you would have an annual dividend income of just under $400 for DGRO and just under $315 for VIG. So for the dividend income, if you would have purchased these two investments on the same day, you would be generating more passive income with DGRO. Now, considering the historical performance of these two ETFs, it shouldn't be surprising to hear that there is a significant amount of fund overlap between DGRO and VIG. In fact, they share 207 of the same holdings, and 53.5% of DGRO's 388 holdings are also in VIG, whereas 83.8% of VIG's 251 holdings are also in DGRO. And so what that means is you're going to have this 60% overlap here with the two funds. So with these two ETFs, I don't personally see a use case to hold both of them. I personally would pick one or the other. I don't think you're going to hurt anything if you were to have both of them, but I don't think there's really a use case where you would want to hold both of them. But that's just my opinion. Now, in comparing DGRO with the S&P 500, looking at the historical performance over the last 5 years, you can see that the S&P 500 has actually outperformed DGRO in terms of a total return. The total return is the dividend plus the capital appreciation. However, if you look over the last couple of years, there have been many times where they've actually tracked each other very, very closely, and in some cases with DGRO outperforming the S&P 500. So that question, or the question of which is a better performing investment, the S&P 500 or DGRO, it really can depend on what time frame you're looking at. Right? And if you're looking at it in the long term, yeah, I believe the S&P 500 is going to slightly outbeat DGRO from a total returns perspective. But for an investor focused on the dividend growth of the investment, I think DGRO is a better investment for the long term if you never plan on selling your shares. That's the big key there. If you plan on liquidating your shares, then yeah, the S&P 500 would be a better investment. Just looking at the numbers here, but the dividend, the passive income of the investment, DGRO would be a better investment in my opinion. So who should consider investing into DGRO? DGRO is a really high quality ETF that I hold in my portfolio. I believe that DGRO could be a great investment for almost every dividend investor out there. And it really depends on a few things of how you allocate DGRO into your portfolio. In my opinion, I think the ETF itself is one of a kind. The index that it follows, the broad diversification that you get, and you get really comparable market returns with the S&P 500, for me, it's really a no-brainer to hold it in your portfolio, at least in my opinion. The way that I hold it in my portfolio is it makes up a smaller percentage of my overall portfolio. And this is really depending on my goals, my time horizon. Now, I'm in my mid-30s and I'm looking to reach FIRE or financial independence and live off of the dividend income in the next 4 years. So I don't have the time for the dividend to compound, right? We talked about the CAGR being right around 10%. That's great, but the starting yield is a little bit too low for my time horizon. If I was in my early 20s, DGRO would make up the largest position by largest weighting in this slice in my portfolio. I would still hold individual companies, but DGRO would be the largest weighting in my portfolio. And that's based off of, a different time horizon. Say I had a 15 or a 20-year time horizon. For me, it would be a no-brainer to hold DGRO at a higher weighting in my portfolio. But once again, it really just depends on your time horizon when you're looking to live off of the dividend, because it really makes a lot more sense if you're going to have a longer time horizon for that dividend to compound. And DGRO, I love the fact that it is so well diversified, and the index that it follows is really focused on the dividend growth. And the thing that I probably like the most about DGRO is the component where it takes out all companies that have over a 75% payout ratio. This is probably the most important factor when you're looking at the ability of a company to grow its dividend. When a company has a large payout ratio, it really diminishes the company's ability to grow its dividend. It makes it so much easier when a company has a low payout ratio to increase its dividend over time. Thank you so much for watching, everybody. I hope that this video was helpful. DGRO is a great ETF. If you'd like to do some more research, I would check out the Morningstar US Dividend Growth Index and take a look and see at all the different companies in there and really understand what you get when you invest into an ETF like DGRO. It's one of the best ETFs out there when it comes to quality, focus on dividend growth, and all of the things that are important for a dividend growth investor. Thank you so much for watching, everybody, and I'll catch you in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say Thanks. I'm glad you came along, partner.